get started.
Welcome, everybody. Welcome to our webinar, Finance 101, How to Finance Greenhouse Homes. My name is Kathleen Goff, and I'm the pre-development specialist with the Center for Innovation, which is the alliance and umbrella organization empowered by the Greenhouse Project and Pioneer Network. I've really been looking forward to today's webinar, and most every conversation we have regarding the development of greenhouse homes or reinventing existing nursing homes to incorporate the greenhouse model, how to finance new builds or renovation is always part of the equation. What financing tools are available today for both for-profit and nonprofit providers? Last week, Greenhouse hosted a development workshop at Otterbein Loveland Senior Life Neighborhood, a greenhouse community in Loveland, Ohio. This 5-home greenhouse community is embedded within a residential neighborhood that provides both long-term care and short-term rehab. While we're offering this webinar as a follow-up to last week's workshop, we're excited that many of you who are not at the workshop are here to learn from our partners at Ziegler. We really want to thank our sponsor, Ziegler, without whom this webinar would not be possible. Ziegler is a leader in the senior living sector, having for decades advised clients throughout the United States and served as the underwriter of financing for hundreds, if not thousands, of senior living projects. The Ziegler investment bankers today are here to share their experience and expertise regarding financing vehicles for greenhouse homes for both for-profit and nonprofit providers. Before we start, though, I do have a few housekeeping items. As mentioned a minute ago, the webinar is being recorded. We will share the recording with you within the next several days. Please be sure to insert your questions into the Q&A feature as you think of them. This will make it easier for us to ask your questions to Keith and Chad once they have completed their discussion. And you're welcome to chat amongst yourself using the chat feature. Just make sure the setting is turned on to everyone. I'm pleased to introduce our two investment bankers from Ziegler, Keith Robertson and Chad Himmel. Keith is a managing director and serves as Ziegler's Northeast Regional Senior Living leader. He has considerable experience in structuring rated and unrated financings, as well as in the solicitation of bank credit for his primarily nonprofit clients. During his time at Ziegler, Keith has participated in financings that have raised in excess of $3.5 billion of capital. Chad is also a managing director with Ziegler and possesses a wealth of experience financing senior housing, healthcare, affordable housing, and multifamily properties. With significant experience in senior living development, Chad also assists clients throughout the nation securing FHA insured loans. So gentlemen, I turn the webinar over to you. Finance 101, How to Finance Greenhouse Homes.
Great, thank you so much, Kathleen. And thank you to everybody who's on today. It's a real honor for both Chad and I to be talking to you about how to finance greenhouse projects. I can go share a little personal tidbit. Back in 2009, I had the honor of participating in the financing of the 100th greenhouse. It was in New Jersey, and so it was a really exciting opportunity for me. We do have a presentation to share with you, so we'll pull that up right now. All right, hope everybody can see the presentation. As Kathleen mentioned, it's both Chad and I. Chad and I both work out of the Northeast region. I dedicate 100% of my time to working with not-for-profit organizations, and Chad, given his wealth of experience, works with both the not-for-profit players in the Northeast as well as many of the for-profit folks. Chad's one of those unique individuals who really does straddle both sides of the industry. So he's a great wealth of knowledge as well. So I'm going to talk primarily about the financing mechanisms that we see most not-for-profits utilize, fixed rate bonds, as well as bank financings. And then Chad's going to, I would say, spend most of his time speaking about more of the HUD and the agency types of financings, as well as some interest rate risk management tools. We're also going to open up the floor for questions. So if you have any questions, please put them into the chat and we'll respond to them at the end of the session. So as we talk to clients about the types of debt that are available to fund projects, there really are three basic types of debt that healthcare providers can utilize. There's tax-exempt debt, both bank and bond debt. There's taxable debt, both bank and bond financing, as well as the agency debt, government programs, and we sort of classify those as alternative debt. And if you are a 501c3 organization, you do have the ability to access the tax-exempt debt markets. And generally, there's on average, a 30-35% reduction in at least a publicly offered bond financing, and maybe a 20% reduction utilizing bank financing. So some of the basics related to tax-exempt bonds, publicly offered bonds, those bonds are sold to primarily institutional investors. Mutual funds like MFS, Invesco, Nuveen, those are generally the types of folks that purchase these types of bonds. Those bonds have fixed interest rates for up to 30 to 35 years, or really up through the final maturity. So there is no variability in those rates. The rates locked in at the day of pricing and closing, and it doesn't vary throughout the life of that issue. The deal itself is structured with an underwriter like Ziegler, working very closely with you, the borrower, to come up with a structure that works for you and your organization and gets the greenhouse project financed, but is also acceptable to the folks who are buying the bonds. So it's really our job to understand both sides of the market and structure deals that work for the borrower as well as the investor. On the direct bank purchase, going back in history, much of the bank debt used to be letter of credit backed variable rate demand bonds. Coming out of the financial crisis in 2008 and 9, we shifted, I would say primarily, but not solely, but mostly over to a direct purchase bonds with a bank. The bank purchases the bonds and they get a tax-exempt rate. Those rates generally are, I would say, generally variable, oftentimes fixed with a swap. Sometimes a bank will offer you a naturally fixed rate, so the rate is locked in. The final maturity of those bank financings might be 20, 25, 30 years, but the bank is only going to commit to you for a period of 5, 7, or 10 years. Some might go out as long as 15 years, but with the fact that the bank is not committed to you for the full life of that loan, there is some variability in it and some risk. Generally, that risk can be managed longer term, but ultimately there is some risk, especially compared to a fixed rate bond offering. One of the benefits of a bank direct purchase financing is those bond proceeds can be drawn down over the construction period, so you aren't paying interest on debt you haven't borrowed yet. So that was tax exempt basics. There's also taxable, both bonds and bank debt, not very different from their tax exempt counterparts, except the interest rates generally are taxable and generally higher. For a taxable fixed rate bond, those rates are fixed through the life of the issue. Those bonds are also sold to primarily institutional investors, maybe some retail for taxable bonds. Generally, there are fewer buyers for taxable bonds, so there's generally less demand and maybe harder to sell. And the terms on those bonds generally are shorter. Looking at taxable bank loans, very, very similar to a tax-exempt bank financing, but just without the tax-exempt factor applied to it. So we do see most banks are generally agnostic between a taxable loan and a tax-exempt loan. The driver of that loan generally is the bank. You go through an RFP process with the banks and pick the bank that is offering you the best deal. Generally, taxable bank loans are utilized for construction generally, maybe to avoid some prevailing wage requirements, and then ultimately taken out by longer term permanent tax exempt financing. There are governmental programs, HUD, USDA, Fannie Freddie loans, low-income tax credits, LIHTC deals that many of you may have heard of, and EB-5 visa program. Chad's going to get more into some of these financings in his section, and there are some REIT financings available, although we don't see a lot of those in the market recently. So I would say on the tax exempt side of the world, there's all those options that we just talked about. But at the end of the day, we really see clients focusing on two primary options. It's bonds and or bank financing. And then when you're sort of deciding which is the right plan of finance for your organization, it really comes down partly to cost of capital, but also to your acceptance of risk. For those of you in your personal lives, you have the option to enter into when you're getting a mortgage, a 30-year fixed rate mortgage. That rate might be a little bit higher. And then, at least when I was younger, was more accepting of risk. I actually did my first mortgage as an ARM, an adjustable rate mortgage. So you're locking it in for a 5-year period, but then at the end of that 5-year period, you have that interest rate risk. So it really depends upon your organization and your willingness to maybe accept a lower cost of capital for a bank financing, but also accept the risk that comes with a deal where the bank and the interest rate is not set for the entire life of that loan. So yes, so it really does come down to your organization's risk tolerance, but it's also really important to understand the pros and cons of both, because there are truly pros and cons of both types of debt, both bond and fixed rate bonds and bank financing. And just going through the conversation with your boards or your management teams to really understand, one, if you accept the risk, and are you in a financial position projected out into the future to be able to withstand some of those risks? Maybe running some sensitivities that if rates went up by 5 percentage points, can you still afford that debt in the future? So those are the kind of things that we recommend organizations do as you decide between bank and bond financing. So a little background about the market. Here's some information about the financings that Ziegler has done. We generally are a leader in the market with a fairly large, sizable market share. I think last year our market share of at least the fixed rate bonds was about 70%. But we do generally average around $3 billion of capital raised on behalf of not-for-profit senior living organizations, and some of that is for greenhouse financings. All right, going to jump into some of the key considerations for fixed rate bond financings. As I mentioned earlier, the rate is locked in for the full life of that loan, longer amortization of up to 35 years. Generally, fixed rate bonds have much more favorable and flexible covenant packages, as well as tests for anything that you might want to do in the future. When we get to bank financing, one of the primary positions of bank financing is the bank is going to want to provide permission to you to really do anything in the future. We call it the mother may I provision, but it certainly is something to consider. So it really does, using fixed rate bonds as your financing vehicle, it does give you a lot of control of what you want to do in the future. There are some things to consider with fixed rate bonds. Generally, the cost of capital is higher. So you're basically paying for the flexibility and that longer term future control. When you do borrow money for a project with a fixed rate bond offering, all the money is borrowed day one and put into an escrow. At least over the past 10 years, that escrow is generally doesn't earn very much. So you're paying interest on money that you've borrowed but haven't spent yet. So generally, we call that negative arbitrage. And now that earnings rates, at least the short-term earnings rates, are higher, the impact of that is a little bit less, but it's certainly something to consider. Fixed rate bond offerings require a debt service reserve fund, especially if your rating is below, say, BBB and potentially non-rated. So that is certainly something to consider. Generally, a debt service reserve fund is funded at 1 year of maximum annual debt service. So it can be a very sizable amount. And those bonds, once you price the bonds, that interest rate is locked in for at least 7 to 10 years. So there's a no call period. So even if rates were to reduce in the future, you can't refinance that debt for at least 7 to 10 years. There is a fairly substantial requirement for ongoing disclosure. The investors want to know how you're doing. And they do require you through a continuing disclosure agreement to provide ongoing, fairly significant disclosure to them. So here's some of the fixed rate bond basics. In terms of security, typically a first mortgage, a gross revenue pledge. And as we mentioned, a debt service reserve fund if the rating is below a certain threshold. Covenant packages, there's always a debt service reserve fund, a liquidity covenant, usually days cash on hand, although bondholders are generally going more to a, or at least the rating agencies have shifted more to a cash to debt ratio. But there are tests for additional debt, transfer of assets, and there is that continuing disclosure requirement. Generally, depending on the investor, the covenant package does vary. Retail investors are generally willing to accept one, a lower cost of capital and a more flexible covenant package. Institutional investors have a fairly standard covenant package that they require, but then banks generally have, I would say, fairly robust and inflexible covenant packages that they require. When you're doing a financing with fixed rate bonds, there are a lot of parties at the table. An underwriter like Ziegler, you have the investor or the bank, a conduit issuer, that's how you get your tax exemption. There's a trustee who watches over the use of the bonds. If it's project financing, there's generally a feasibility consultant, an auditor. There's a lot of lawyers around the table: bond counsel, borrowers counsel, underwriters counsel, bank, issuer, trustee. So we call it the Full Employment Act for all the lawyers, any bond financing that we do. And there's also some real estate required participants as are listed below. So there's a lot of documentation. We have listed here. There's I would say the primary lending document is the bond indenture. A lot of the business terms are outlined in the master trust indenture. There's a loan agreement between you and the issuer. So there's just a lot of documentation that has to get worked through. In terms of disclosing and offering the financing to the bond marketplace, there's a preliminary as well as a final official statement. Your story is the Appendix A. There is a continuing disclosure agreement. If it's a project financing, which is what we're talking about here, there's most likely going to be a feasibility study or a very robust forecast. So there's just a lot of work that has to be done. Here's a diagram of really how the parties to a financing work. You as the borrower, you're over on the far left. You have an agreement with that issuer, and then we borrow or lend the money directly to the issuer. The trustee is looking over everything, and then we raise the money directly from the bond buyers. So here's the flow of funds from Ziegler to the bond buyers. Let me go over this in detail, but it's a fairly complex process because there is that issuer and the trustee. So that's just the process of issuing tax-exempt bonds. So as you're borrowing money in the tax-exempt bond market, there's a lot of factors that go into the interest rate that you lock in. And as we price bonds in the market, you could price a bond deal today, the exact same financing, the exact same credit a year from now, and the rate could be very, very different because there's just a lot of factors. There's a lot of macroeconomic factors that affect the pricing of bonds, supply and demand, your credit strength, the size of the deal, which determines how many investors you actually need. So there's just a lot of things to consider. And it does fluctuate fairly significantly from day to day, week to week, month to month, and year to year. Right. So we know there's been a lot of conversation recently about how interest rates have increased a lot significantly. The index that we price bonds off of is called MMD. And MMD right now is slightly higher than its 10-year average. It's about 3.5% right now. But you can see, going back to really 2014, MMD has been below the 10-year average. But if we look back, going back to the course of my career, which is about 27 years, going back to the early 1990s, MMD has averaged about 4.38%, and we're only at 3.5% right now, which means even though we're higher than we have been over the past 5 or 10 years, interest rates in general are either at or below longer term historic averages, which means it's not necessarily a bad time to borrow in comparison to what folks have done over the past 20, 30 years. Here's a graph indicating the yield curve. You can see that the yield curve, there's 2 points to make here. This is looking at the Treasury bond. Treasury bonds are yielding more than they did a year ago. But more importantly on this slide, the yield curve is inverted, meaning that shorter term rates are higher than the longer term rates. That's not typical. The yield curve that we had a year ago, the green line down the bottom, that's a typical shape of a yield curve where the lower interest rates are lower than the longer term rates. But right now, given inflation, with the moves that the Fed has made, and some of the fear in the market right now, the yield curve is inverted. Generally, an inverted yield curve, you'll hear the economists or the experts say that's generally a sign of an upcoming recession, and that's still yet to be seen. Looking at, I would say, longer term historic rates going back 30 years, and I would say most of the greenhouse projects that we'd finance would be non-rated projects, unless there's some kind of credit support, which would bring it into the rated category. But looking at a long-term 30-year loan for a non-rated project, the current rate would be roughly 6.5%. That depends upon the state. There's a lot of different factors, as you saw on that prior slide, that can influence where rates actually land. But right now, we would assume roughly 6.5%. If you go back 30 years, that long-term non-rated rate is about 6.55. So as I mentioned earlier, we're right around historic averages. So despite being higher than we have been for a while, it's still not a bad time to borrow. What's driving the increase in interest rates? A lot of it is flow of funds into the mutual funds that buy tax-exempt bonds. And as you can see from this graph, all the gray up top and the red lines down below, the gray are inflows and the red is outflows. So recently, going back for the past year and a half, the bond funds primarily have experienced very significant outflows from the funds. There's been a slight tick up of inflows over the past week. And we do hope that continues because that will, from a supply and demand perspective, if there's more money in the funds that buy our bonds, then ultimately rates should theoretically come down. Now, here's a slide looking at the total net asset holdings of the mutual bond funds. And you can see going back to 2021, where we hit a peak between 21 and 22, where the amount of money that they have to invest has declined fairly significantly just over the past year or two, hence the increase in rates. All right, we're going to dig a little bit deeper into bank financing, bank financing can be both tax exempt and taxable. The way banks look at it generally is they'll offer you a taxable rate in their proposal, but also within their proposal have a tax exempt factor included. So if you choose to go down a tax exempt path, then you just apply that tax exempt factor, generally 79 to 81%. So historically, a lot of folks have looked at bank financing partly because it has at least a shorter term, lower cost of capital. But when you're funding a project, the ability to draw the money down has been very, very impactful, especially as shorter term interest rates were so low. So you're not necessarily paying interest on money that you haven't spent yet. It's one of the real benefits of bank financing. We are seeing a little bit of a shift right now because those shorter term interest rates are high. And if you borrow all the money up front, then you can invest it and get a fairly decent return with a very safe and liquid security. So the ability or the ability to do a drawdown is less impactful today than it was even a year ago. But I think there is still some benefit to not paying interest on money that you haven't borrowed yet. Bank financing generally doesn't require a reserve fund like a fixed rate bond financing does. And there generally is not a prepayment penalty. So that certainly is one of the benefits. And cost of issuance, the amount of documentation that is required, generally is much less than a fixed rate bond offering. Some real risks that your organization needs to be aware of when you're looking at a bank financing. As we mentioned, the bank is only going to commit to you for a period of say 5, 7, or 10 years. At the end of that 5, 7, or 10-year period, the bank has the ability to put those bonds back to you, even if you're unable to refinance it. So the bank has the ability to escape that relationship. If there's been a change of direction for the bank, if there's a reduction in credit quality. So at that 5, 7, or 10-year mark, you may be sitting there without a lender with some money that you have to finance. And along with that bank put risk or bank renewal risk, as we call it, there's also interest rate risk. So you could enter into a fixed rate offering, bank offering right now, either through a natural fixed rate or with a swap. But at the end of that 5, 7, or 10-year period, because you shouldn't go out beyond that commitment period, you're subject to renew your rate at whatever that current market is. And as we're in a much higher interest rate environment today, those folks that are renewing their bank financing today are experiencing much higher rate than they had 5, 7, or 10 years ago. A bank does have a loan to value requirement. Generally, I would say 70 to maybe 80%. Some banks may go as high as 85%. They generally don't want to be that high, but that means you have to put in some equity as well. A lot of organizations either don't have a lot of equity or don't choose to put in a lot of equity, and that may steer them towards a fixed rate bond offering where you don't have to put in a lot of equity at all. But it certainly is a requirement among the bank market. Banks generally like I would say a shorter term final amortization, generally 25 years, 20 to 25 years. And as we mentioned before, the institutional bond investors are okay with a 30 to 35 year amortization. The banks generally like a much more restrictive covenant package. They really don't want you to borrow additional money without their approval. So as I said earlier, they have what we call a mother may I provision within all their documents. And they just want to be a party to all major decisions that are made at the organization that they lend into. And because of that, you don't have as much control about your future when you have bank financing. Here's just a slide looking at the banks that are generally lending to our sector and would fund a greenhouse type project. And this slide does change over time. But I can tell you right now, the bank market's fairly challenged. We all know about Silicon Valley Bank, Signature Bank. And so it's certainly been a challenged period of time. But when this current challenge, I would say, stabilizes, which I think we're seeing now, these are generally the banks that you'll find in your markets. And it is, I would say, regionally driven. Chad and I work primarily in the Northeast. So you'll see the banks that lend to us very different from the banks that lend out west and down south. Many of you have heard that, well, most bank loans historically have been LIBOR based. LIBOR is an indice that loans are based off of. LIBOR is going away. It's called the LIBOR sunset. And actually, LIBOR won't be posted after June 30th of this year. So in about 2 weeks. We've been preparing for this for about 3 years now. And it's right around the corners. So most banks, if not all banks, have shifted away from LIBOR, haven't been able to enter into a new LIBOR loan since, I believe, December of 2021. But most banks have either converted over to a new index, and that index is generally SOFR, which is it stands for Secured Overnight Financing Rate. As well as we hear that some banks might use other indices, but we've made that conversion. Any bank loan that has not converted to SOFR will probably need to do so in the next 2-week period of time. We've been talking about this for a long time, and I'm glad that we only have 2 more weeks to talk about it. So bank rates, they've gone up. They've gone up a lot over the past, over the past year. But really, rates were kind of hovering around zero, or at least the indices were hovering around zero for a very, very long time. But you could even see that a strong A-rated on a variable rate basis is still like around 4.5%. And as you go a little bit higher, maybe you're in the 5.5% range, but it's still lower than that 6.5% rate that we saw for a non-rated fixed rate transaction. So with that, I'm going to turn it over to my colleague, Chad Himmel, to talk through a summary and as well as some of the government programs. Chad.
Thank you, Keith. So we're going to start with the government program that's most frequently accessed by long-term care providers and senior living providers, which is the HUD program. HUD finances properties across the spectrum from multifamily apartments all the way to hospitals through multiple programs. We're going to focus on HUD's Section 232 program, which is the program through which operated by the Office of Residential Care Facilities that provides financing for licensed residential healthcare units. So think of it as skilled nursing, assisted living, memory care, and to a lesser extent, some independent living if it's part of a campus with licensed units. So this is just a summary of the various programs underneath the 232 program. The first column is new construction and substantial rehabilitation. So most of the projects we're talking about here today would fall into this first category. That's the Section 232 program for new construction sub-rehab. And if you're looking at a refinancing of a loan for nursing home or assisted living, you're looking at the Section 232 program pursuant to the Section 223F. 223F is HUD's refinancing program for refinancing debt that's not currently HUD insured into a HUD insured loan. Another in the section, their 223A7 program is a program in which HUD refinances its own debt. So HUD insured mortgage gets refinanced with another HUD insured mortgage. And for construction projects to reposition, say, a nursing home that already has a HUD loan on it, and you want to reposition that, but leave the existing HUD loan in place, you can do what we call a supplemental loan, which is HUD's Section 241A program. That can be beneficial, particularly if your first loan on the property is a Section 232 pursuant to 223F, because that's really the one way you can fund a major construction project with a HUD deal without a prevailing wage requirement on construction labor. So we'll talk about that here in a minute. So why are folks looking at HUD loans? Typically speaking, the reasons to go through HUD are long-term, relatively low cost of capital with very little risk on the back end. They focus primarily on cash flow, not balance sheet liquidity. So they don't look at you like a rating agency, look at every project individually typically. So there's no renewal risk. So in that way, it's like a fixed rate bond. You have the right to refinance it over time, but you never have to refinance a HUD loan. Typically, historically, no debt service reserve fund. That is something that changes from time to time with market conditions and really specifically with each project. For a project with significant construction and primarily significant fill-up risk, HUD may require a debt service reserve fund equal to maybe 6 months of debt service or something like that. But that's not always the case. It's not a programmatic requirement by them, but they do apply that to certain projects where they see the need to mitigate a little additional risk. There are no traditional financial covenants for HUD. So you don't have a debt service coverage covenant or a days cash on hand covenant or anything like that long term. The rules are really pretty straightforward. You pay your mortgage, please. And we'd like you to, and there are some conditions in the operator's regulatory agreement to maintain positive working capital. So there are conditions in which an owner can take cash can upstream cash out of a HUD borrower, but they want a condition to maintain positive working capital. So you have to put the liquidity back on probably a semi-annual look back basis if there's ever a case where there's negative working capital. It is non-recourse to the parent entity. So each HUD deal is for a single purpose entity, a single legal entity that owns that asset. There are no guarantee requirements back up to the parent. No calls with bondholders or consultants. So if you miss a debt service coverage covenant, you don't have to go out and hire a consultant to help you figure out how to fix that. And like a bank loan, the debt can be drawn down over time as the money is needed for construction. So you avoid that negative arbitrage that Keith mentioned earlier that can be in play at times with a fixed rate bond transaction. So So if we back up a little bit about what is HUD, so HUD was created in 1934. HUD is not a lender, right? HUD provides mortgage insurance. So private lenders like Ziegler submit applications to HUD for mortgage insurance. So we submit a HUD application. It's not a loan application, it's a mortgage insurance application. And we typically will fund the loans through the sale of a Ginnie Mae security to investors, very frequently placed with a REMIC, which is a real estate mortgage investment conduit. There's no risk-based pricing. So a REMIC is going to buy every Ginnie Mae security basically on the same rate based on current prevailing market conditions. But how strong or weak your project is doesn't have a material bearing on your cost of capital. If HUD approves a project, you will pay your mortgage insurance premium to HUD, and then we'll sell that Ginnie Mae security to an investor. So your cost of capital really becomes the interest rate that the Ginnie Mae purchaser buys. There's a Ginnie Mae guarantee fee that's 25 basis points you get paid on every loan, and there's the mortgage insurance premium that HUD charges. So when you think about your interest rate for a HUD loan, it's those three factors all combined into one. Ziegler is a approved HUD lender, Ginnie Mae issuer and servicer, and have been since 1970. So key considerations when you think about a new construction project for a HUD loan is you are going to be looking at a 10 to 15% equity requirement, maybe 20%. How that a lot of that's if there are reserves, there's a working capital escrow and there's an initial operating deficits escrow that typically are funded from equity, and those get applied to that equity requirement. So you got to have some experience with new construction projects. HUD is probably not going to approve you if this is your first construction project. So that is something to keep in mind. And there are ways to try to mitigate that risk by bringing in a partner who does have experience, but that's something to keep in mind. If there's existing debt on projects being replaced, we got to take that into account in the refinancing, because you're not going to have HUD is not going to share a first mortgage position on a piece of property with another lender. You want to be thinking about, when you think about how big your loan is, you want to be thinking about EBITDA margin relative to construction costs. And that's nothing unique to HUD. But quite frankly, as you're thinking about any project financing, you're measuring your cash flow against construction costs, and that's really a key component of whether a project is feasible or not. HUD does have its own thoughts on cap rates when they think about loan to value and valuations. So appraisers will typically tell you that there are two sets of cap rates that they use. If they're doing an appraisal for a commercial loan or a bank debt or bank deal, as Keith was mentioning earlier, they'll use a particular cap rate. If they're submitting an appraisal for a HUD loan, it will probably be a slightly higher cap rate for both assisted living and skilled nursing, because HUD will push back on them if they use cap rates that are generally acceptable to commercial banks. That's one of the ways HUD applies a little conservative underwriting to their transactions. So when we think about payer mix, a common theme we'll see is someone operates an existing nursing home that's got 80% Medicaid, and they say we want to replace it with this new nursing home that's only going to have 50% Medicaid. We're going to say, wait, we have to vet that, because HUD's general payer mix assumption is that 70% of your beds will be occupied by Medicaid residents, and of that remaining 30%, no more than 15% can be either Medicare or private pay. And the only exception to that is if you're doing a replacement facility and you historically operate at a better payer mix than HUD's typical underwriting assumptions, if you meet that condition, you can use your historical payer mix. But it's very hard to get HUD to buy into a significantly improved payer mix because you're replacing the building. So it's just something to keep in mind as you're running your financial models. And the depth of market relative to HUD standards. So there is a market study component to the appraisal when it's completed. So you have to keep that in mind when working through the application. As I mentioned, every HUD deal is a single asset, single purpose entity. So very frequently it's an LLC. If you're a not-for-profit or for-profit entity, it's an LLC. For-profits will sometimes have partnerships holding those assets, but always single purpose operators. Again, typically an LLC under a larger operating company. There's a permissibility of independent living. It will be rental independent living, not entrance fee, and it should comprise no more than 25% of the total units of the campus. That can be pushed a little higher. HUD has allowed sometimes up to 35 to 50%, but as on special cases. As you're thinking about a new campus, should not be thinking about significantly more than 25%. In the Section 232 program, there is a prohibition against equity takeouts. In the multifamily world, HUD will actually, if you have $10 million of debt on a building and $20 million and a $20 million valuation, they might approve the full $16 million loan amount and allow you to take equity out. But to take out equity is the difference between the new loan amount and the old. In the Section 232 program, they will not do that. So as you're thinking about a refinance of something with a HUD loan under the for a nursing home or assisted living with HUD, you're not going to take equity out directly with a HUD loan. There is a regulatory agreement. There's a little difference typically between not-for-profits and for-profits. Typical for-profit operating assumption, regulatory agreement has a residual receipts allowance, which means at the end of basically every fiscal year, you can determine how much additional cash you have on the balance sheet above and beyond what you need to have to operate the building, and you can transfer that out, transfer that cash out. Whereas not-for-profits historically have a surplus cash requirement, which restricts the removal of that cash. In exchange, historically, not-for-profits got higher loan to value requirements and lower debt service coverage covenants. There can be times when the not-for-profit can elect to accept the lower thresholds that a for-profit will accept to be able to transition cash out of that entity. So that's something to be thoughtful about when crafting your loan application, is whether you want to be considered as a not-for-profit or for-profit for loan to value purposes in exchange for an ability to transfer cash out. Eligible transaction costs, there HUD may be a little more restrictive on things like developer fees, as an example, or mortgage broker fees or things like that than a bank deal or a bond financing may allow. A bank, in a tax-exempt bank or bond financing, we can use 2% of the loan proceeds for cost of issuance. HUD doesn't have that kind of limitation, but there are some limitations on exactly which costs can be utilized. The application process can take a while. So construction financing for a HUD, you would expect to be probably a 12-month process beginning to end, with the first few months spent preparing the initial application. Then you submit basically the appraisal and some background documents on the borrower. If HUD likes what they see, then you come back later with the architectural drawings and the construction contract. But you expect that to be a 12-month process, and maybe as much as 18 months, depending on how busy HUD is at the time. As it turns out right now, you can probably get through HUD a little more quickly because they don't have as much of a backlog in applications. HUD does allow accounts receivable financing as well. That's typically easier to get accomplished in a refinancing than a new construction loan, but it's something to keep in mind as a positive for a HUD transaction. So if you juxtapose the HUD transaction against the bond transactions Keith talked about earlier, typically your HUD interest rates are a little bit lower. Although right now that's actually fairly close between HUD loans and bonds. There's no loan to value limitation for a bond deal. There is for a HUD deal. Valuation requirements, again, there's really no limitation on valuation for a bond deal. There is for a HUD deal. Amortization, fixed rate bonds are long, HUD's even longer. It's a 40-year amortization for a HUD construction loan. So that's something to really keep in mind, is that really helps bring your annual debt service down. Timing, this says similar. I say that's similar for a refinancing. For a construction financing, I think you'd expect a HUD loan to be significantly longer though than for a bond transaction. Restrictions on cash distributions, there are less in a bond deal, more in a HUD deal. I think that's well stated here. More covenants for a bond deal, more flexible covenants for a bond deal than a bank transaction, but HUD really has no covenants after you get through the loan application process and closing. Much less ongoing compliance requirements for a HUD transaction, maybe a debt service reserve fund or not, but typically for a non-rated bond financing there is, and there is a liquidity requirement for a bond deal, but not for a HUD deal. So in the healthcare program, HUD has administered the LEAN program for these under the Office of Residential Care Care Facilities, which really has streamlined the application and approval process to make it a little more user-friendly, or if not more user-friendly, more predictable. I think it has worked. There are times when it gets tougher. There are times when interest rates are low and a lot of refinancing applications are in HUD, where their queue can be pretty long to get a project into underwriting. But I think it's generally been a positive change for HUD, and that happened 14 years ago, but we feel it's been pretty well accepted by the market. So I'll shift gears here, and I'll say this about HUD. HUD is applied across the country pretty uniformly. That's one of the advantages of the LEAN program. It's not regional. It's really, they look at it from a national perspective. USDA is another government program that can be used to fund these types of projects, but USDA is definitely geographic. You cannot apply for USDA loan for a building in Manhattan, for example. It's a town called Manhattan in a state that is a very rural area, because the USDA program is really established to provide affordable funding to develop essential community facilities in rural areas. The facilities have to provide an essential service, and they typically in towns with populations no greater than 20,000. Essential community infrastructure ensures rural areas have the same basic quality of life and services enjoyed by those in urban areas. These are typically, the community facility programs offers direct loans, loan guarantees, and grants. So there's a number of different funding vehicles. Eligible borrowers include public bodies, federally recognized tribes, and then most importantly for this conversation, community-based nonprofit corporations and organizations. How can they be used? So you can use USDA loans to construct, expand, or improve facilities, purchase equipment, and pay the related expenses for the project that educate, promote public safety, and provide public services. Essential facilities include, and this is key for us, healthcare facilities such as hospitals, medical clinics, nursing homes, or assisted living facilities, but also town halls, courthouses, street improvements, childcare centers, utility services, et cetera, et cetera. Look at the bottom bullet there on this page. Funds can be used to pay related project expenses. So legal costs, architectural engineering, financial advisory, funded interests, or capitalized interest, whatever term you prefer to use. So you can use the loan proceeds to fund all the costs associated with the construction project, not just the construction costs. So terms, the funding is provided through a competitive process. Repayment terms are not dissimilar from HUD. Can be up to a maximum of 40 years, but cannot exceed the useful life of the facilities. Typically for construction, residential facilities are looking at a 40-year useful life for the buildings. So maybe something a little less than that when you factor in equipment in the building, but typically very long amortizations. Once the loan is approved, the interest rate is fixed for the entire term of the loan. So in that way, it's similar to a bond deal or a HUD transaction. There are no prepayment penalties, and then there's just like all these other finances, there's a security interest in the facilities finance. So you're looking at a mortgage or some other collateral consideration. Other considerations that you have to be have legal authority to borrow the money. So that's no different than any other financing vehicle. The second bullet here on the bottom, the applicant must be unable to finance a project from their own resources or through commercial credit at reasonable rates and terms. What does that typically mean? It typically means when times are hard, like right now in the capital markets where it's challenged, USDA can be a valuable backstop for us. When banks are out there lending aggressively, it's a little harder to make that claim, but typically we don't see that as a significant holdup for projects that otherwise meet the criteria for USDA. So I'll turn now to talk about interest rate management. And this is really important when you're factoring in, when you're thinking about bank financing. Think about bank financing, as Keith mentioned earlier. And why is that? Because typically banks lend, as Keith mentioned, on a SOFR-based loan. So your underlying interest rate is based on the SOFR index plus a credit spread, but the banks typically do want you to hedge that interest rate risk. So the risk of SOFR going up significantly and hurting their credit, meaning making your debt service too high for you to afford, they want you to mitigate that by entering into an interest rate swap, where you trade that variable rate for a fixed rate, or a cap where you buy insurance to make sure that your rate never goes above a certain level. Interest rate swaps and caps, as I mentioned, the swap converts the floating rate. The cap puts a limit on how high your rates can go. They're based on a notional amount that's usually tied to the amount of debt you're borrowing. Most commonly, it's 100% of the debt borrowing. Sometimes the bank requires it to be at least 50%. If they're saying at least 50%, that means you've got some significant liquidity and can absorb the potential risk of increased rates. But more often than not, for these projects, we're looking at a 100% hedge transaction. If it's with a swap, we call it a synthetic fixed rate because we're effectively locking the rate for the term of the bank's commitment. Why do people when and where do we see swaps and caps used? On the left-hand side of this, there's a lot going on here. On the left-hand side here is a swap illustration. The right-hand side is a cap illustration. See the curving line is effectively what the market currently estimates. What the swap market tells us they estimate interest rates will be over the next 20 years. And you see we're in a high rate environment right now. They expect it to go down. So if you look at the left-hand side, a current fixed rate, synthetic fixed rate with a swap with a 2.5% credit spread over the 10-year swap SOFR swap rate would get you to a 6.12%, and that would be locked in for a 10-year period. By comparison, on the right-hand side, if you buy a cap at 4%, with that 2.5% spread, you're locking in at 6.5%, but your rate will never go higher than that. But when the rate gets down below that 6.5% threshold, you are saving money. So there are pros and cons using a swap and a cap. I'll say far more frequently we see borrowers utilize a swap than a cap because a cap does require an upfront payment. In this case, if it costs you $738,000 for I think it's a $10 million loan here to buy that 10-year cap, so it's a pretty significant upfront cost. Things to think about with these hedging products: you do have counterparty risk, so you do have to you typically are entering these contracts with the bank that's giving you the bank loan. But historically, there were cases where that did not happen. The most notable was with Lehman Brothers. A lot of borrowers had swaps with Lehman Brothers. When Lehman Brothers went bankrupt, their swaps were no longer valid, and actually cost people a lot of money to get out of those. Basis risk: if there's a mismatch between the index that you're using for the swap and what's on your bank in the index used for your bank debt, there can be some basis risk. So we generally encourage people to keep those working with the same index. And early termination risk. So a swap has a value. A swap is an asset that has a value. Typically, when you close a swap, the asset is benefits to the borrower, to the bank. So it sits as a liability on a borrower's balance sheet. But if you terminate it, that contract gets marked to market. And if rates have gone up, then you might actually the bank may have to pay you to get out of that swap. If rates have gone down, then you have to pay the bank to get out of the swap. So that's a mark to market that is something that's different from a bond deal where you would typically have a prepayment schedule. Then as time goes down, the premium goes down, and then eventually paid off with no premium. As I mentioned, there's a mark to market for a swap deal. But back up, a bank will typically want you to have a swap advisor. Ziegler does have a banker internally named Scott Dieterman, who works as a swap advisor for borrowers. But the banks typically want to have you engaged and represented by a swap advisor. The swap will be marked to market. That will impact your audited financial statements. So that the value of that swap will go up and down. As I mentioned on an early termination, there is a mark to market process. So Kathleen, for us, that's the end of our formal presentation, and we're happy to stand by and address any questions that folks have.
Well, thank you very much. That's a whole lot of information to digest. That's for sure. I have a general question, which I am asked a lot by different people. And kind of generally speaking, when you finance a new project, does it include money for the pre-development costs, or are you looking at construction costs?
It's a great question. Oftentimes those pre-development costs are funded through cash equity. And they are able to be reimbursed at any kind of permanent and or construction financing, but it really depends upon what makes the numbers work. So if those pre-development costs are substantial enough where you can't roll them into the project financing, then they'll have to stay in as equity. But generally, we try to return as much as we can.
And Kathleen, we do advise our borrowers, particularly not-for-profit borrowers, if they're going to be spending equity to fund pre-development costs, that they work with their counsel and their board to adopt the reimbursement resolution. If they adopt the reimbursement resolution, then under tax code, they can recoup the costs they incurred for pre-development back to the date of that adoption of the reimbursement resolution and 60 days there, before that. Without a reimbursement resolution, it becomes much harder to use tax exempt bond proceeds at least to fund the pre-development costs.
And if you're a new startup, and I know there's some people on the webinar that are with community organizations that are looking to develop greenhouse community projects or kind of mixed use projects that incorporate greenhouse, are there funds to help with those development costs if they don't have equity to bring, or a large amount of equity to bring to the table?
So there are sources of capital, but generally, I would say higher risk seed capital, like what you're talking about, is quite expensive. But we do have access. We generally use a program called BANs, bond anticipation notes, but the interest rate there is anywhere from 8 to 10% on a tax, or 8 to 12% on a tax exempt basis, higher on a taxable basis. So we generally like to see some equity cover some of those early costs.
Okay.
The other possibility for that, Kathleen, and we see with a lot of greenhouse projects, philanthropy become a part of the process, a part of the capital stack, and that can be used to fund the pre-development. Quite frankly, development of a person-centered care model in a household setting is appealing to a lot of donors who are intrigued by the concept of a better way to care for seniors. And we've seen a lot of not-for-profits, especially, have a lot of success raising capital to fund greenhouse model projects. And that's probably the first source is you can think about who may be your sympathetic potential donors. Talk to them about what you're trying to do, how you're trying to change how care is delivered in the marketplace you serve, and see if they're willing to invest in that along with you.
That's a great point, Chad. I know that's been very successful with many of our greenhouse adopters. A question just came in regarding USDA loans. What percentage is needed from the borrowers?
That's an excellent question. And quite frankly, I have to come back to you with an answer on just what the equity requirement is, what the loan to value requirements are for the USDA program, because I have to go back and just confirm that for you.
Okay.
I think you can typically expect for government projects, you're looking at 10 to 20% equity requirement. I just don't remember exactly where USDA's threshold is in that scheme.
Okay. And when you talked about USDA, mostly in rural settings, you talked about having different types of projects. Could they work for a project that might have greenhouse homes, daycare, which could be adult and or child daycare, housing, either for elders, independent living, and or workforce housing?
It's a great question. We think about what it's really used for is for community services for rural markets, so they can. I would think so, but in terms of how exactly that falls under the definition of what you can fund with USDA projects is pretty broad. All right, it's virtually all the essential services, and I think you'd have to determine whether that qualifies under the heading of essential services.
Okay. Another question that came in is, can nonprofits still benefit from tax exempt loans? Does that mean the borrower benefits from tax exemption?
Yeah, that's really what I was talking about. They both tax exempt bonds as well as bank loans get the benefit from that tax exemption.
And it's most explicit in a bank deal where, as Keith mentioned, the tax exempt factor is 79 to 81%. Practically speaking, what that means is the borrower receives a 19 to 20%, 21% discount on their interest rate. So just as an example, if your interest rate on a taxable loan would be 5%, it'd be roughly 4% for a tax exempt bank loan, all other things being equal.
Okay, I know we only have time for a couple more questions, but if you're a new entity, what credit score would be used?
They really don't put a credit score on a borrower like this. Any bond investor and or bank would be looking at the project metrics and the quality of the provider, the experience level, really the experience level of the entire team, the contractor, the architect, as well as the manager, to determine if the credit quality is strong enough to invest in, and then look deeper into the projected metrics to kind of put the interest rate on it.
Okay. Another question, are there minimum loan amounts or generally rules of thumb for minimum size of projects to make third-party fees work? An example would be a bond issuance.
Yeah, that's a good question. So generally, a publicly offered fixed rate bond offering has fairly substantial costs of issuance. In terms of making those fees efficient enough to make sense, I would say for a fixed rate bond offering, it's probably 10 million or higher. For bank financing, it's a little bit lower. I would say my rule of thumb is generally 5 for tax exempt bank financing, and then 10 for a fixed rate bond offering, but that's like very generic.
Okay, 2 other quick questions. Can the value of land be used as equity?
Generally, yes, in a manner of speaking. It goes into the overall value of a property. So if you're trying to do a bank financing where loan to value is important, they do calculate the value of the land.
Okay, and then someone's asking that we just wanted clarity of which options are available for profit models. And am I correct in assuming, Chad, that's primarily what you spoke to?
I would say it's primarily, you're really looking primarily at bank financing and HUD financing for not-for-profit borrowers, for-profit.
For-profit.
It would be taxable bank financing, not the tax exempt piece.
Correct.
But USDA would be primarily for nonprofit.
Yes.
Okay, okay. Well, I want to thank you, gentlemen, for this great webinar, everyone who participated and submitted questions. We will try to answer many of them to everybody. As we mentioned earlier, we will be sending out a recording of today's session, and you should receive that within the next couple of days. I also want to bring to your attention that Greenhouse Project and Pioneer Network through the Center for Innovation, we're hosting a conference in Pittsburgh, July 23rd through 26th. A lot of training and education. Primary tracks are leadership, innovation, workforce, and working with elders with dementia. Would kindly invite you to look at the registration page for more information, which Janet just posted for us. We also have a new on-demand education and training called Empowered Ed, and we're starting with a person-directed living certificate, which will help frontline providers learn how to provide person-directed care, working with elders. Again, we ask you to visit our website to learn how you can incorporate this within your communities or with your care providers. And as we have for the last couple of years, Susan Ryan, our president and CEO, hosted a podcast, Elevate Elder Care, with many interesting conversations and topics. And we would invite you to join Susan and also Penny Cook in upcoming podcasts, which are come live every Wednesday. And with that, we'd like to thank you, gentlemen, and wish everybody a great rest of their day.
You're very welcome. Thanks for the opportunity.
Thank you.
Take care. Bye-bye.